Good Monday. This is Jay Brew, co-chairman of Seafried & Brew. Well, last week, Vice-Chairman Hoenig of the FDIC gave a speech, and what it was about is something that is close to all of us community bankers, and that is regulatory relief. And he laid out what he felt in terms of traditional banks compared to riskier banks. He looked at bank failures and the level of capital that different banks that failed had. And so what he came up with was this list that you will get regulatory relief are that banks that hold effectively zero trading assets or liabilities, banks that hold no derivative positions other than interest rate swaps and foreign exchange derivatives, and banks whose total notional value of all their derivative exposure, including cleared and non-cleared derivatives, is less than $3 billion. But he added into this number in terms of capital, and looking at 10% would also be included on this list to get regulatory relief. And when we look at that and its impact, is that what kind of regulatory relief was he talking about? That these particular, what we call traditional banks, or what he's defining as traditional banks, Basel III will be taken off the table. Call reports will actually have a decline in terms of the amount that need to be put into call reports, and looking at moving the exam cycle up from 1 year to 18 months. So there is some regulatory relief here, especially for those of you who have been doing the call reports along with Basel III, that we've been hearing that some of this has been very onerous to put together. But we have to think about those banks that have different levels of capital. And we've been talking about this before, that my feeling is that the industry is way overcapitalized. So then when we look at it, which he mentioned, is that the average of these banks have currently a 10% Tier 1 leverage, is that in fact our national peer group of banks, $5 billion and less, had average leverage, Tier 1 leverage of 10.1%. If we look at it from the standpoint of the bank where I'm a founding director and on the board of directors, is that we're at 8.53% in here in terms of our leverage ratio. But the key here is in terms of all returns. So when we look at it, the average ROAE, return on equity, for that benchmark group of banks is 7.52%. The return on equity at our bank at the end of last year was 11.28%. So a question would be around this whole 10% capital situation that come to mind as I think about this. Will this force banks to lift up their capital and lower their overall returns? And then the question is, could this really start to consolidate the industry? But more importantly, what I've always been after, especially when we looked at Dodd-Frank and the Basel III, and arguing that community banks should not be part of Basel III because of their risk, is that the concern in my mind is that just simply putting a capital number out there to say that you're less risky just doesn't work. And I point out the book that Dr. Ed Seafried and I wrote, which is called The Total Risk Index Predicted 99% of Failed Banks. Why isn't the FDIC looking at this in terms of what prevented? It wasn't 10% capital that prevented the failed banks. What we were looking at was credit risk, very high credit risk, very high liquidity risk, and along with that high earnings at risk, that they just didn't have any way to capitalize that type of risk, be it 10% or not. So my feeling is that to give regulatory relief where it is due and should come back as quickly as possible, is that it should be those banks which adhere to real traditional conservative community banking. This is Jay Brew, co-chairman of Seafried & Brew. Have a great week.